Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
Yep. And I'm going to share my screen. While I'm doing that, a reminder today we are having a webinar with Interactive Brokers at 2 p.m. Correct, Will? And
Large option delta volume trade
yeah,
screen.
and that will be, it's a new feature that we just published yesterday. It was under the hood. I was testing it. So I think it's ready. Hopefully there are no bugs because, it's always the first day or week, there's unexpected things happen when other people use it, but we'll talk about it. And it'll be at 2 o'clock to get, different perspective on options trades and basically looking at them from the perspective of like their deltas. And just as a quick quick reference, it's under the option block trade screener. It's right here, the delta volume screener. So this is what we'll be talking about later today at 2 o'clock. And I know they right before we started, they announced that they're going to be doing some tests on their alarm system here. So if they start that and it's too loud, I might have to cut it short. Just
No worries.
a warning, because they did just announce that they're going to be doing those tests. Oh, you know what? Hold on, Will. I think they're at the door right now. Actually,
All right.
Talk for a second. Let me just go see what they're.
No worries. Mission
Okay.
control. All right. So I put the registration out on the chat. Everyone, you have to go to that registration large option delta volume trade screener. Click on the IBKR webinars. You register there. You don't have to watch it today. It sits there forever. Just so you know, we've done probably 29, 30 of these shows with IBKR, and they all live on the website. And I will put right now, there's a library of all the shows. You can click on this link and have access to all the previous webinars, which is a real nice feature, and they lay it out beautifully. Rob Black is asking, is Dimitri in Florida? I think he wishes he was in Florida, Rob. He's in the city of brotherly love.
Hey,
D, you're back.
yeah, sorry. Yeah. So, yeah, they just not let me know that they might be testing that alarm.
So literally, did they go through the whole building? And
I think so, yeah, and like just checking and seeing if it's working. But I think then they're gonna just start making sure that those fire alarms are working. But they were blasting it a couple minutes ago. I think maybe hopefully they're done.
Rob did ask, can you please give a little preview of the new feature?
Well, because I'm going to talk about it more extensively this, for like an hour with Interactive Brokers.
Yeah, and then we'll talk about it, I'm sure, after
Yeah,
tomorrow. A lot of the interactive broker people sometimes come over. Maybe we'll get some more questions. Maybe we'll talk about it again tomorrow on the show.
yeah, and because I had another question come through an email that I said that I would cover, let me try
Oh,
to
excellent.
cover. Yeah, because I did have another question come in right before that. But for this webinar, you do have to register with Interactive Brokers. Well, I don't know if you told
It's
everybody.
out there. Yep.
Okay. So I had a question come up, and usually this is why we do the show, to take questions. But I did have a question come up through the email, and let me try to cover that. because that was a request to cover it on the morning show. And it had to do with, let me come here to implied vol movers. And it had to do with a calendar spread. And the question was, well, if you're doing a calendar spread around earnings, right? So typically on earnings, you'll see implied volatility of the options elevated, right? And that's because of the earnings event. Option premiums go up. And what you'll typically see is that when there's an uncertainty or an event that could cause high volatility, a big gap move, then you'll see an inverted curve, right? So let me show you what that looks like before we get to the question. And I'm going to use this just to find one of them. So let's look at something that in the next 7 days, I'm going to look for a high implied volatility and a stock. Let's just say the stock has to be above $25. I don't want to do it on like a low price stock. So what I did here was I filtered out just options expirations that expire anything next 7 days. So you could see here December 15th and the stock above $25. And so the first one here is RILY. And you could see here that the implied volatility of that from on December 15th is 171, right? That's at the money IV. You could see here the implied move 17%, and it looks like it has an event December 13th. All right, so probably tomorrow it has some kind of an event. So just like earnings, I think that this may look similar as far as like the term structure, inverted term structure. So let's go to that here, RLY. Just going to click on that to go to the options chain. So right here, we're on RILY, and you could see here, these are the implied volatilities for the different expirations, right? So December 15th, that has an event, right? The implied volatility is 171. The next month, December 22nd, is 158. So basically, the implied volatility of the from month is higher than the expiration following. And intuitively, people look at that and say, well, then obviously, if I think implied vols are going to come in, then I should sell the higher IV, right, and buy the implied volatility in the following month. And the idea there is, well, because I sold the higher IV and bought the lower IV, and if implied vols come in, they start to converge or even go the other way, revert, that will be a profitable trade, right? So the whole thought process here is that I'm trying to get short Vega, implied volatility, right? I have to be short Vega to benefit from the IV, let's say, crush, right? The implied vols come back in. So let's just say they come back in here. This is the historical vol, like to 70, right? Right now, and I don't know what's going on with this stock. I just kind of scanned for the first one. Maybe there's something else going on here. I don't know, like a takeover or something. But let's just say that, I believe that they come back because I see that the stock volatility has been high too. But let's just say for our purposes, that's what we're looking at. Well, I'm selling the higher vol, buying the lower vol. But you have to keep in mind here that you're doing it in two different expirations. And there are two things here to consider. It has to do with, what are implied vols, right? Implied vols are, it's a metric, it's a calculation from a Black-Scholes formula or an option pricing model, right? This one in particular is the binomial, and it gives you this number. This is a number based on a model, right? So you're plugging in all the all these inputs, the option price, and then it gives you this number. Well, what does the number actually mean, right? So that's what it's what the number means from the option pricing model. And the option pricing model itself has assumptions. Okay, and the assumptions themselves are important, because if you don't understand the assumptions, then really, if you're looking at these numbers, they're meaningless. Okay, they're absolutely meaningless unless you understand all the assumptions in that formula. Okay, so you could run any calculation, right? You could calculate, but if you don't know the assumptions in that calculation, then it becomes meaningless. I'll give you a simple, if I say the average house in this neighborhood sold for 200,000. Okay, well, that's a number, but how did you get to that average? Like, what were I assumed that, I only took the last month of data, right? Well, maybe there's only, so let me look at that data. Maybe there's only like one house there, or did you take out outliers? So there's always these underlying assumptions that you must understand. And in the option pricing model, it assumes that there are no gaps. So that's an important assumption, because obviously that's not happening in the earnings. When there are earnings, there are gaps, and because of that, the implied volatility, okay, becomes less meaningful. Okay, that's number one. So when we're talking about situations, and most of the time the Black-Scholes model, the stocks don't gap, right? They're just moving continuously throughout the day, and they trade through every price, but that doesn't happen on earnings. So it's very important when you're using just the implied volatilities themselves. You have to understand what the underlying assumptions are behind that number. So now we're looking at this and we're saying, okay, there's a
D,
higher number here.
Can you just review the clicks? And I don't know, it's a delay, so I don't know exactly where
I'm just on the options chain on
Yeah.
ROI, just to pick something because what's happening is that you're zoning in on these numbers, right? And that's what you're looking at. I'm looking at two numbers. One is higher, one is lower. And intuitively, I need to sell the higher number, buy the lower number, because if they both go down, then voila, this makes money, right? That's the assumption. So another thing to keep in mind is that you're looking at two different expirations. And how do options work? The vega of the options are not the same as you go out further in time. So option sensitivity to an implied volatility move increases as you go out further in time. It has a larger vega. So I'll show you here in this example. I'm going to turn to the vega. So over here, let's just take the 26, let's just say 26 strike. Or here, 25.5 strike. It's right there. The vega of this option is a penny. Let me see. These might be really close. Let me just check if I have to go out further. Okay, this one is 2 pennies. So these expirations are very close. But just let's take a look at, these are rounded. But what does this mean? The vega of this option that expires December 15th is a penny, meaning for each implied volatility move, one vol click, right? One vol click, this option will change by penny, up or down. One vol click up, it goes up a penny. One vol click down, it goes down a penny. Then I go to December 2nd. This is 2 pennies. So you could see that the sensitivity of this option is 2 times the sensitivity of this. Okay, and that's just for the first vol click. All right, and keep in mind it's not linear. So as I go out further in time, it increases. So this option the implied volatility change by 1 is not the same as this option, implied volatility change by 1. In other words, that this doesn't translate to a dollar value, equivalent dollar value, right? So if we move implied volatility down by 1 vol click in December 15th, it's not the same as moving down the 1 vol click, let's say I go April 19th. Here it's 5 cents. Okay. So the vega, or the sensitivity of the option as we go out further in time, increases, right? It has bigger impact on the option, right? So let's set this up, right? So the assumption is that, what if I only care about trying to see if I think, well, both of these volatilities are high, 171 and 158 are high, right? If I'm looking at both of them and saying, I think both of them should go to 70 after this event. So let's just say this is my assumption, that they both go to 70. So obviously this has to travel further down from 171 to 70 than this one from 158 to 70. So intuitively, you're thinking, I'm looking at two numbers, right? 171, 158. That's all I'm taking into consideration. Then the calendar spread makes sense to sell this one and buy that one. So let's see what that looks like. So I'm going to sell the 25.5 call at 210. Then we go out here, December 22nd, and we buy this one, 330. So let's calculate that. So here's the spread. All right, here's the spread, $1.20, let's just say. And you can see here, we sold the front month, bought the next month out, right? So we sold the higher IV, bought the lower IV. And this is what the payout diagram looks like on December 15th. So on December 15th, it looks like, well, if the stock remains the same, then this is profitable, right? And remember, this is assuming that the implied vol didn't move. Well, why is it profitable? Because on December 15th, I sold this for 210. That means I get to keep the premium if it's right at the strike. And I still have this option left over December 22nd, at the same IV. But look at the Greeks. Look at my Greeks. This is saying that I'm short gamma, which makes sense, right? Because I want the stock to sit here. I don't want it to move. But I'm long vega. So in actuality, my position here, my Greeks tell me that I want implied volatility to go up. Not down, but I want it to go up. Because that's what the position is. Because now I'm long vega, right? I actually bought vega. And when you buy vega, and implied vol comes in, your position's coming in. Now this is vega across 2 different months. So what is the best case scenario? If we want implied volatility to go down, right? Let's say our bet is that we want an implied volatility crush. So what's the best? The scenario is that they all go to 0, right? Well, if you're betting on an implied volatility crush, your best scenario is that it goes to 0. So let's do that. Let's say they both go. I'm not going to go. I can't give it 0. Give it a 1 vol. So I'm going to change both of these to 1 vol. All right, both of these to 1 vol. I'm going to recalculate it. So look what happens. No matter where the stock is, you're done. All right. There's no opportunity anywhere along that curve to be profitable. That's the ultimate implied volatility crush, right? That everything just goes to 0. So you could see here that wouldn't work. But what if it, let's say it reverted back down to 70, right? So keep in mind, like I just put both of these options into one vol, right? So no matter where you are, you can do it the day before. Let's say we're on, December 13th. You can see there's nowhere along the curve. Here, I'll go out, 20%. That it would be possible in this instance for this strategy to be profitable, right? Because your net debit, everything went to zero. So then let's go put it at 70. Let's see if that would work. So I'm going to put both of these, at 70. Is that expiration. So even if you're right at the strike, where's your sweet spot? That the option that nothing moves and implied volatility comes in, and you could see here what's going on. Like, why is this happening? All right, there's nowhere along the curve. Why am I losing? And it has to do with, that you're long Vega. Okay, that's your position is long Vega. This is the Black-Scholes model, right? This is we're plugging in the inputs, and this is the Black-Scholes model that you're long Vega. Because when we look at implied vols across different expirations, what we have to consider is what is the Vega of the option, right? Not the implied volatility, but what is the Vega of each of these options, and what is my position? Because the sensitivity of the option price to an implied volatility move becomes important. That's what you need to start considering. It's not just looking at these two numbers. Otherwise, it'd be very simple. Because think about it this way: if it's looking at just these two numbers, and this is going to happen on every mostly earnings. That's what it looks like. That this month will be higher. If it was just these two numbers, it would be very simple to arb that. You could do that in an automated way all the time. So the important part is, okay, there's a Vega component to each of these options. And where do you think the implied volatility will settle afterwards? So then the question is, so how do we play the short Vega? What would be the opposite? Because here, what happens is, let's come back up. Let's start December 22nd. At 270, right? I'm selling this at 270. Well, what happens is the following: at 270, I'll do the straddle. Let's do the straddle here. Well, here, what happens is that my position, I get a credit, is short Vega and short Gamma. I'm gonna short a little bit delta, but here I'm short both Vega and Gamma. So my exposure here is to, I do have my short Vega, which I want because I'm thinking that these options will come in right after some events. So these options will come in. So I have the short Vega, but I also have a short Gamma position, and I'm exposed to a gap move. Why? Because if the stock moves by a lot, it won't matter anymore if the implied vols come in, right? So I'm bringing in 550 credit. We could see if the stock gaps to $40, it won't matter where the implied vol goes, because my options will be in the money, right? It'll be in the money by more than I collected, right? So what happens there is that, yes, I'm short Vega, but I'm also short Gamma, and I'm exposed to a large stock move, right? Well, how do I hedge that stock move? That means I need to buy some Gamma somewhere and maintain a short Vega position. So where's the biggest Gamma, right? Well, the biggest Gamma is in the shorter dated option, right? That covers this event. So if I come over here on December 15th, right? Now we're buying these. So let's see how that looks. All right. So now look at this. So I'm long Gamma, right? So I want the stock to move. I want the stock to move beyond this. I'm long Gamma, but I'm also short Vega. So let's see how this one would look if vols came in. So I collected a credit, and keep in mind this whole position is based on something happening December 13th, right? So my expectation is December 14th, all these will come in. So let's say that they all come in to 70. Implied vols all come into 70. Recalculate that. So now it looks this way. So you see here, of course, you're still long Gamma. So if it doesn't move, you're going to decay. But you could see here that that's what it would look like. So what is happening is you're short Vega and hedged the move. All right, that's what's happening. The other way around, you're short Gamma but long the Vega. Right, so you could see here that this here is not based on the implied volatility move going in. This is just based on a lack of movement in the stock. Hopefully that makes sense.
Yeah, that's super helpful, D. And hopefully the person who asked the question is watching. That was super helpful. Actually, Mike says this is a good lesson. I need to pay more attention, which is great because it sits there on YouTube and you can watch it at any time and come back with questions tomorrow if you want, Mike. Remember, everyone, we have a webinar at 2 p.m. today. It's our monthly webinar with IBKR, the second Tuesday of every month. Large options trade screener, correct, D?
Yeah, Delta Vought. Yeah, we're gonna do so the idea behind there is we're filtering out large trades that, either calls or puts. It's not multi-leg trades, but either just straight calls or puts, but we're aggregating trades that have large deltas to the trades, and that's what we're going to analyze and talk about.
Perfect. Awesome job, buddy. We'll see you at 2 today. Thanks so much.
All right. Thanks, everyone. Stay safe out there. Have a good trading session. Hope to see you guys later this afternoon.